While the market obsesses over AI and tech, Warren Buffett is quietly making his biggest moves in years. The Oracle of Omaha has amassed a record-breaking $320 billion cash pile, the largest in Berkshire Hathaway's history. But here's what most investors are missing. Buffett isn't hiding from this market. He's hunting it. In the past quarter alone, Buffett has dumped billions in Apple shares, slashed his Bank of America position, and completely exited his S&P 500 ETF holdings. Yet simultaneously, he's been aggressively buying three specific stocks that Wall Street isn't talking about. One is up 86%, another has increased by nearly 50%, and a third is in a brand new position that could signal where the smart money is heading next. What does Buffett see that most investors don't? And why is he betting billions on these three unlikely companies while everyone else chases tech and AI? The answers might completely change your investment strategy for 2025. Warren Buffett has always lived by a simple principle: be fearful when others are greedy, and be greedy when others are fearful. Right now, the Berkshire's cash pile reaching an unprecedented $320 billion. Buffett is sending a powerful message to the market, one that contradicts the euphoria driving today's stock prices. This isn't just any cash position. It's a fortress of liquidity that gives Buffett something most investors lack in today's market: optionality. As he often says, cash is a call option with no expiration date, an option on every asset class with no strike price. The headlines have focused primarily on what Buffett is selling: trimming his Apple stake, reducing positions in Bank of America, Citigroup, and Capital One, and completely exiting his S&P 500 ETF positions. These moves have led many to believe Buffett is bearish on the entire market. But that's where the mainstream narrative falls short. The real story isn't what Buffett is selling, it's what he's buying with laser-focused precision. While most investors pile into overvalued AI stocks and tech giants, Buffett is quietly allocating billions to three companies that operate outside the spotlight: businesses with durable competitive advantages, strong cash flows, and reasonable valuations. This dual strategy, raising cash while selectively deploying capital, speaks volumes about Buffett's view of today's market. He's not abandoning stocks altogether, he's being extraordinarily selective. As he once said, the stock market is a device for transferring money from the impatient to the patient. And right now, Buffett is patiently positioning Berkshire for what could be the investment opportunities of the decade. Constellation Brands, Buffett's $1.2 billion beer bet. The first stock on Buffett's shopping list has caught many analysts by surprise: Constellation Brands, ticker STZ. A leading producer and marketer of beer, wine, and spirits, has seen its stock plummet by 25% in just the first 6 weeks of 2025. Most investors have fled, citing concerns about tariffs, declining wine sales, and shifting consumer preferences. However, while short-term traders panic, Buffett sees an opportunity. In the past quarter, he poured over $1.2 billion into Constellation, making it one of the most significant recent purchases. So what does Buffett see that the market is missing? For starters, Constellation dominates the imported beer market in the United States. Its flagship brand Modelo Especial recently dethroned Bud Light to become America's #1 selling beer, a remarkable achievement that underscores the company's growing market power. The imported beer segment continues to grow at approximately 5% annually, significantly outpacing the broader beer market. What's particularly impressive about Constellation is its pricing power, a quality Buffett has always prized in his investments. While wine and spirit sales have struggled industry-wide, Constellation's beer business remains robust, demonstrating that consumers are still willing to pay premium prices for its products even in an inflationary environment. Management's strategic focus also aligns perfectly with Buffett's investment philosophy. The company is aggressively cutting costs, expanding distribution, adding 500,000 new retail points, and executing share buybacks that reduce the outstanding share count and increase per share value. These moves create a powerful combination of margin expansion and earnings growth that the market is currently overlooking. The biggest fear weighing on the stock is potential tariff impacts, but this concern appears overblown. Approximately 75% of Constellation's supply chain is U.S.-based, which significantly softens any tariff blow. Additionally, the company's core consumer base, Hispanic Americans, is growing twice as fast as the broader U.S. drinking age population, creating a demographic tailwind for years to come. Our track record: finding tomorrow's winners today. Our quest for finding the next Tesla or Nvidia stock continues, and the results speak for themselves. First, we called IonQ at $10. Today, it's trading above $40. Then came Quantum Computing Inc., ticker QUBT, our Nvidia-like pick, which we recommended at $2.50. It shattered expectations, soaring to $27 in just 2 months and now hovering above $10. We spotlighted AppLovin at $75, and it skyrocketed to $400, now holding steady above $350. And MicroStrategy, a gem we identified at $130, reached a high of $530 and is sitting comfortably near $380. For those who acted on our insights, these gains have been nothing short of transformational. Now, our private Discord members already know our next potential 3x stock, which is still within the buying range. Join us through Patreon to access timely buy and sell alerts, in-depth market analysis, and a thriving community of over 1,000 investors. Click the link in the description. Your breakthrough stock could be waiting. Domino's Pizza, not just fast food, but fast growth. The second stock Buffett is loading up on might seem surprising for the world's greatest investor, Domino's Pizza, ticker DPZ. In the last quarter, Berkshire boosted its stake in Domino's by a staggering 86%, bringing its total holdings to 2.3 million shares worth nearly $1 billion. Many investors dismiss Domino's as just another fast food chain, vulnerable to inflation, labor costs, and changing consumer preferences. But Buffett's massive purchase suggests he sees something far more valuable: a global delivery powerhouse with an ironclad franchise model and some of the best margins in the quick-service restaurant industry. The key to understanding Buffett's Domino's bet lies in the company's business model. With over 20,000 stores across 90 countries, Domino's operates primarily through franchises. This capital-light approach means the company collects royalties and fees without taking on the high operational costs of running individual locations. The result? Predictable cash flows, high margins, and strong returns on capital. All characteristics Buffett has prioritized throughout his investing career. Even more impressive is Domino's growth trajectory. Under its Hungry for More strategy, the company plans to open 1,100 new stores annually, expanding its already massive global footprint. The recent delivery partnerships with Uber Eats and DoorDash, expected to drive $1 billion in additional sales over the next 3 years, tap into an entirely new customer base that was previously ordered from competitors due to platform preferences. Its remarkable cost discipline and pricing power truly separates Domino's from its peers. While competitors struggle with inflation and margin compression, Domino's runs one of the most efficient supply chains in the industry. This operational excellence translates into exceptional profitability metrics: an 18% EBIT margin, 19% EBITDA margin, and a 12% net income margin, all far surpassing industry averages. Digital innovation provides another competitive moat. Domino's was early to embrace mobile ordering and has built one of the most sophisticated delivery tracking systems in the industry. Nearly 80% of its orders now come through digital channels, creating valuable customer data and reducing labor costs. The stock's recent pullback presented exactly the kind of opportunity Buffett loves: a temporary dip in a high-quality business with durable competitive advantages. By nearly doubling his stake, Buffett is signaling a strong conviction that Domino's combination of scale, operational efficiency, and growth potential is significantly undervalued by the market. Pool Corporation, the hidden gem in Buffett's portfolio. Now for the third stock in Buffett's buying spree, perhaps the most overlooked yet potentially most insightful about his current market strategy. While investors obsess over AI and tech disruption, Buffett has quietly increased his stake in Pool Corporation, ticker POOL, by 48% in the last quarter, bringing Berkshire's total holdings to nearly 600,000 shares worth approximately $200 million. Pool Corporation isn't a household name, and that's exactly why it's worth paying attention to. As the world's largest distributor of swimming pool supplies and outdoor living products, Pool dominates a niche market with remarkable consistency and profitability. The stock has struggled, down 10% over the past year, but has stabilized in 2025, suggesting a potential inflection point for long-term investors. What makes Pool Corporation special is its business model, a cash-generating machine with a deep economic moat. With 440 distribution centers across the United States, Europe, and Australia, Pool serves over 125,000 customers with unmatched scale and efficiency. This dominant market position gives it significant pricing power, strong supplier relationships, and operational efficiencies that smaller competitors simply cannot replicate. The genius of Pool's business lies in its recurring revenue streams. While new pool installations can be cyclical and tied to housing market conditions, maintenance products like chemicals, filters, and cleaning supplies are essential regardless of economic conditions. Pool owners must maintain their investments year after year, creating stable, predictable demand that translates into consistent cash flow. The numbers tell the story. Pool boasts a 31% return on equity, steady 30% gross margins, and strong free cash flow that funds both share buybacks and dividends. Even as discretionary consumer spending slowed in recent quarters, Pool's maintenance segment continued to grow, demonstrating the resilience of its business model in challenging economic environments. Looking ahead, falling interest rates could provide a significant tailwind for Pool Corporation. Lower financing costs make homeowners more likely to invest in pools and outdoor living upgrades, potentially unleashing pent-up demand in 2025 and beyond. Buffett's increasing stake signals that he sees this catalyst on the horizon. The psychology of successful investing. As Warren Buffett once said, some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own stocks at all. What are dumb things? Selling a stock as it goes down. Buffett explains, if you buy your house at $220,000 and somebody comes along the next day and says, I'll pay you $150,000, you don't sell it because the quote's $150,000. You look at the house. This wisdom couldn't be more relevant than it is right now. The market in 2025 started with significant uncertainty. No year-end rally, immediate volatility, last week's deep sell-off, and now fresh tariff concerns. Historically, these kind of headwinds crushed markets for weeks or even months. But this time, something different is happening. The market isn't just surviving, it's showing remarkable resilience. As of early February, major indices are already up 2% to 3% for the year, proving that today's market is built on a stronger foundation than many realize. These shakeouts don't destroy real investors. They eliminate weak hands, the ones who panic sell at every dip only to chase stocks back at higher prices. Meanwhile, those who understand what they own, real businesses with real value, are buying these dips, accumulating shares, and positioning for potentially massive upside. If the market can stand strong through all this chaos, imagine what happens when the dust settles. The rally could be explosive, especially for investors who followed Buffett's lead and bought quality companies at reasonable prices. As we look ahead to the next 30 days, Warren Buffett's contrarian moves provide a valuable roadmap for investors. While most of the market chases overvalued tech stocks and AI narrative plays, Buffett is quietly positioning Berkshire for what could be the next phase of this market cycle. What do you think about Buffett's recent moves? Are you following his lead or taking a different approach to today's market? Share your thoughts in the comments below, and don't forget to subscribe for more in-depth market analysis and investment opportunities.